Hello dear learners. In the last video, I had introduced you to the concept of risk and how risk is important in insurance. Today we will learn more about what insurance is, and I'll be introducing you to the concept of insurance. So let's begin. Let's start with the objectives of insurance. The objectives of this video will be: what is insurance? What are the major acts which govern insurance in India? What do you understand by contract of insurance, and what are the common terminologies which are used in insurance? So what is insurance? Learners, in earlier days in India, on an unexpected death of a breadwinner in any family, the villagers or the neighborhood would collect some funds to help the survivors in the family, and such practice continues even now. Insurance is exactly on a similar pattern. Insurance is a social device which combines the risks of individuals into a group, and it uses the funds contributed by the members of that group to pay for losses. Insurance is a legal agreement between two parties, that is, the insurance company, who is the insurer, and the individual, who is called the insured. In this, the insurance company promises to make good the losses of the insured on the happening of certain contingencies. The contingency is the event which causes a loss. It can be either the death of the policyholder, or it could be any damage or destruction of the property. This is called a contingency because there is an uncertainty regarding happening of that event. The insured, on the other hand, pays a premium in return for the promise which is made by the insured, and this consideration we call premium. Let's come to some of the major acts which govern the insurance business in India. The Insurance Regulatory and Development Authority of India, that is IRDAI, it is a statutory body under the jurisdiction of Ministry of Finance, Government of India, and is tasked with regulating and licensing the insurance and reinsurance industries in the country. So the major acts which govern the insurance business in India are the Insurance Act 1938, the second was the Life Insurance Corporation Act 1956, next came the Marine Insurance Act in 1963. Next was the General Insurance Business Nationalization Act, which in short we call GIBNA, which was introduced in 1972. And the last was the Insurance Regulatory and Development Authority Act, IRDAI Act, which was introduced in 1999. Alright, let's talk about contract of insurance. As I told you in the previous slide, a contract in which the insurance company undertakes to make good the loss of another, whom we called an insured, by payment of some money to him on the happening of a specific event, is a contract of insurance. Now, the formation of an insurance contract is subject to the fulfillment of the requisites of a contract defined under Indian Contract Act 1872. In addition to these features, which are common to commercial contracts as well, the contracts of insurance contracts are subject to certain special principles evolved under the common law in UK and which are followed by the Indian courts as well. Now, these principles are known as the fundamental principles of law of insurance. We have often heard in the advertisements saying that insurance is a subject matter of solicitation. Now, what does that mean? That means that this insurance has to be requested or asked for, and it is not sold. This is a mandate by IRDA, and we therefore find it in all advertisements of insurance. Now, before we move ahead and before we go deep into the subject of insurance, we need to understand some common terminologies which are used in insurance. So today we will be talking about these common terminologies. The first one is the insurer. An insurer is the company that designs and sells the insurance policies and pays out the compensation at the time of loss. The second is the insured. So, the person or the persons named in a medical insurance policy are called the insured. In case they fall sick and are required to be hospitalized, the insurance company covers the expenses. The third term is subject matter. So, what's the subject matter in insurance? The person or the property which is being insured in insurance is called the subject matter. The next term is premium. So, what's a premium? I had already told you that a premium is referred to as the amount of money paid to the insurance company to keep the insurance plan active and to be able to access a continued coverage. In the event the premium is not paid prior to the payment being due and exceeds the grace period as well, the policy comes to a close. That is, the policy gets terminated. The next important term is risk. So, risk is the possibility of some loss which is happening or which is expected to happen. Next is policy. Policy is a document which describes the terms and conditions of the insurance contract. The next important term in insurance is policy holder. So, the policy holder is a person who has bought the insurance policy, and a policy holder can be understood to be the person who seeks to purchase a life insurance policy and pays the premium associated with it. They can also be understood to be the owner of the policy. And it's important to note that the policy holder need not be the life assured. They both can be different persons. The next important term is life assured. Life assured is the term which is used to address the insured individual. The life assured individual is the one for whom the insurance plan is bought and for which the coverage is provided in the unfortunate event of their untimely death. Ordinarily, the breadwinner of a family is identified as the life assured under most insurance policies. Now, the person who is the life assured may or may not be the policy holder. The next important term is the nominee. So, who's a nominee? The term nominee is used to identify the person or legal heir who has been nominated by the policyholder and to whom the sum assured along with any other benefits will be paid in case the life assured dies. So, the nominee could range from the policyholder's wife and children to their parents. And should the policyholder die, the nominee is required to claim their life insurance. The next important term, policy tenure. So, the duration for which the policy is active and for which the insurance coverage is provided is referred to as the policy tenure. This tenure can range from 1 year to 100 years or even up to an insured individual's entire life. The next important term in insurance is rider. A rider is an insurance policy provision that adds benefits to it. Like if you have bought health insurance, you can buy a critical insurance rider along with it. Riders expand the scope of the basic insurance policy, and these may be availed of when the plan is first bought or on its anniversary. That means at the time of renewal. Now, the kind of riders available may vary from one insurance company to another. The next important term in insurance is the sum assured. The primary purpose of life insurance is to provide a life cover to those that are insured. The sum assured is used to refer to the amount that is agreed upon that the insurance company will pay in the event that the insured involved or insured individual dies or another insured event occurs. Let's see some more terminologies. The next term important to insurance is the grace period. A grace period is the extra few days that you can still pay the premium for your health insurance or for your insurance policy after the due date is over, just to ensure that the policy does not lapse. The next important term in insurance is term insurance. So, a term insurance policy is a pure life cover. It doesn't have any investment involved in that insurance. So, you pay a premium to an insurance company for a specific number of years, and in return, in case you were to meet with an untimely death, the insurance company will pay the nominees the amount of sum assured, and compared to other life insurance products, term insurance provides a much cheaper life insurance cover. It provides higher coverage for less premiums. The next important term in insurance is no claim bonus. So, a no claim bonus, that is NCB, it's the way by which the insurance companies reward the policyholders for having a claim-free year. So, if you don't claim anything in the year, then you can have a higher coverage, that is a higher sum assured amount at the same premium level. The next term is waiting period. So, what's a waiting period? The waiting period is the kind of a hibernation period, you can say, during which no claims will be admissible. The waiting period might vary between 1 and 4 years. The next term is beneficiary. Beneficiary in insurance is the person or the persons of your family, such as your spouse, your children, or your parents, who will receive the sum assured for your term insurance, and if you die during the policy tenure. The next important term is the health insurance. What's a health insurance? A health insurance plan, as we all know, it ensures the coverage of the medical expenses which are incurred, like hospitalization expenses, or maybe room rent charges, or maybe some operation theatre charges, or maybe some doctor fees, and so on. So, it can be claimed by you and by any family members which are covered under the plan. Let's move on to the next term. The next important term is group health insurance. So, when your employer or a professional association that you are associated with, it provides health insurance to you and other employees, or to the members of that association, it's called a group health insurance. Next important term, a free look period. This is ordinarily applicable to any new insurance policies which are purchased. Now, this time frame is used to refer to the period during which a newly insured individual can return the policy that they have purchased. The next important term is actuary. So, learners, a qualified statistician and mathematician who carries out the research in order to effectively calculate the risks and the premiums related to insurance, we call him an actuary. Let's move on to the next term, which is agent. So, a state licensed, a government licensed representative appointed by the insurance company to solicit, to negotiate, and to execute the insurance contracts on behalf of the company, and someone who also provides services to the policyholder is termed as an insurance agent. Let's move on to the next term, which is the death benefit. So, what's a death benefit? The death benefit is the total sum that the insurance company pays to the nominee in case of the policyholder's death during the term of the policy. Now, this is generally equal to the sum assured. However, in insurance plans where riders are involved, the death benefit can be higher than the sum assured. The last important term in insurance is maturity benefit. So, there are some policies which pay the policyholder an amount in case he or she survives the policy term. This is known as maturity benefit. So, with this, we have covered all the important terms related with the basics of insurance. In our next video, we will be going deep into the concepts of insurance. Thank you so much.